This morning, I am going to chat about, besides answering any questions you might have, I am going to chat this morning about the difference between getting an FHA loan, when to look at FHA, and a conventional loan, and when to look at that. And the reason I'm going through that is that I know we've touched on this before, but I still get a ton of questions about, Greg, when should I take conventional versus when should I take FHA? And it's interesting, there are still people that think that if you get a conventional loan, you have to put 20% down. And that's just not the case. So what we're going to do is chat about the differences. And 1, 2, 3, 4, 5, 6, 7 differences plus 2 subset differences. So there's a lot. And you don't have to remember all of it. You just have to remember my phone number so that you, I'm kidding, of course, you can reach me and then I can answer questions for you. But borrowers are oftentimes, people think first-time home buyer, I have to get an FHA loan. No. That's number one. And can somebody tell me, I've asked this question before, what is considered a first-time home buyer?
Anyone who hasn't owned a home in the past 5 years?
Almost.
3 years?
3 years, 36 months. Thank you. So anybody, you can own 10 homes, but if you have not owned a home in the last 36 months, you are considered a first-time home buyer. So virtually anybody, almost a first-time home buyer. I know it's crazy, isn't it? But that's what they do. All right, so let's take the next thing. Somebody has an FHA loan now, and they decide that they're going to, they've had that home for 5 years. Now they're gonna keep that house because they don't want to sell it, but they want to get another FHA loan because their credit score is so-so. It's not the greatest, which we'll talk about in a moment. And can they do that?
Yes.
They can. Okay, interesting. Anybody else feel differently? The answer is no.
No.
You can only have one FHA loan at a time, unless that property is going to be some distance, and there's kind of a guideline there, maybe 100 miles or so, but it doesn't necessarily mean that's the case. You can only have one FHA loan at a time. Now, let's say that Chris is living here in Atlanta, decides to move to Lakeland, Florida, and he's going to go down to Lakeland, Florida. He needs to get an FHA loan because that's where his job is going. He doesn't want to sell the house here yet because he thinks he can make more, make rent, whatever. He can get an FHA loan because he's moving. Another instance, you can get another FHA loan. Say that you own a home in Marietta and now you want to buy a home in Kennesaw. And again, you got to get an FHA loan. Well, you say, well, look, when I bought this home in Marietta, it was just me and my wife. There were 2 of us. It's a 2-bedroom place. We have 4 kids. We have 3 children now with a 4th one on the way. We need a bigger house. You're going to move to Kennesaw. As long as we can document all of that, you can get another FHA loan. So is it possible? Yes. Probable? No.
Could you refinance your FHA into a conventional?
Yes, great question. Can you refinance your FHA to conventional? Absolutely you can. But I'm going to raise up a little trick here. When you go to refinance your conventional loan, if you know that you're going to be buying a new primary residence, when you refinance, let's just say that right now somebody calls me up and says, Greg, I'm going to refinance my loan. I want to refinance it, get it out of FHA, put it, because we've made all this money on it, and I'm going to want you to do my next loan, because I'm going to buy a new house probably in September or October. So I'm thinking, okay, wait a minute, Wes. Now think about this. I'm doing their primary residence refinance, right? What did they just tell me? Their primary residence isn't going to be this house. In 3 or 4 months, their primary residence is going to be a different house. What's the nasty word for that? Fraud. You want me to refinance your primary residence. Okay, if I'm going to refinance your primary residence, I cannot have knowledge that you're buying another house in 3 months. Because if you want to refinance your FHA loan into a conventional loan and it's going to be an investment property, no problem. Now, you've probably heard of people doing this. If you've got a good lender, if you call me, for example, I'm going to say, I can't do your refinance, but I can do your purchase. But Greg, I want you to do both. And it's not going to happen. If you want to refinance that home into a conventional loan and tell somebody that it's a primary residence, you go do that with someone else. I will do your new one, I won't do this one. I'm not going to do both. And I have to, quick story. We just had a situation like that. Someone in this office had a situation identical to that, but they didn't use me. The lender told the borrower and the real estate agent, no problem, I'll just do this one and then we'll get the other one done right away. Well, underwriting is not the same as a salesperson, a loan officer, and the underwriter caught it and said, you can't, wait a minute once. I can do one or the other. This is an investment property. So that's why I'm saying you got to be very careful. There's ways to do that, all right? Any other questions on that part? First of all, first-time home buyer, doesn't have to be FHA, can be conventional, doesn't make any difference, all right? Let's look at, yes.
The circumstances between the family, like increasing with the children and whatnot, what are the specific circumstances that make them able to get another?
There's no, great question. What are the specifics in terms of family size growing? There are no specific. If you look at the guideline, there is no guideline that says if you go from 1 to 3 or 2 to 4 or 0 to 5. It doesn't say that. That's up to the lender's discretion. Lender's going to have to look at it. Does it make sense? I have a 1-bedroom condominium. We have got 1 child. We've got a second one on the way, and we need to move into a house. That makes sense. Those are the kind of things. It's got to make sense, okay? Great question. All right. Down payment. What is the minimum down payment on a typical Fannie Mae, Freddie Mac conventional loan? Minimum down payment, first-time home buyer. 3%, thank you. Is there another instance, not a first-time home buyer, where somebody can get a 3% down payment on a conventional loan?
VA. It's veterans.
There is. It's called Home Ready, Home Possible, affordable lending. Fannie Mae and Freddie Mac each have a program. Fannie Mae is called Home Ready. Freddie Mac is called Home Possible. It's an income-generated program. If you go over a certain income, then you cannot qualify for Home Ready or Home Possible. But if your income goes below 80% of the median income for that census tract, you can then get a Home Ready, Home Possible loan at 3% down. So first-time home buyer or Home Ready, Home Possible. FHA, what's the minimum down payment on FHA? 3.5%, exactly. Now, so people say, but Greg, can't you get down payment assistance? The answer to that is yes. We're not going to talk about down payment assistance. If you're just getting a standard FHA loan, 3.5% down. Are there any restrictions to a 3.5% down on FHA like there is on conventional? No. When you're shaking your head, no, there's not. Anybody can get 3.5% as long, assuming you qualify with your debt to income ratios, which we'll talk about in a moment. So the fallacy is, well, I got to go FHA because I only have to put down 3.5%. I don't want to put down so much to do conventional. Well, wait a minute once. If you're a first-time home buyer, qualify for Home Possible or Home Ready, you might be able to do 3% down, which makes it less. So then somebody says, well, Greg, why wouldn't everybody do conventional then? Somebody tell me, why wouldn't everybody do conventional?
Credit score.
What's that?
Credit score.
Credit score? Perfect. What's the other one? One other one.
Credit length.
What was that?
Credit length.
Well, debt to income ratio. Those are the 2 things that are going to drive people away from conventional into FHA. First is credit scores. Now, credit scores. You know, anybody can get an FHA loan if you have an 800 credit score. I've never done that. But believe it or not, I have done an FHA loan for somebody with a 770 credit score. And that's because of the debt to income ratio situation, which we'll talk about in a moment. Generally speaking, if somebody's credit scores go below 700, you're going to see better terms on your loan. By terms, I'm talking about interest rate and potential discount points, if any. But if you're going to go below 700, we're going to look at both conventional or FHA. If you go below 680, we're going to look real hard at FHA unless you're putting down a ton of money. Because FHA rates are going to be much better than conventional rates are going to destroy you when you get down below 680. You go below 660 down to 640, conventional is going to really kill you. So we're going to look at FHA. That's in your break points. Now, FHA, you can go down real low on credit scores. You can go, like our bank will go down to 600 on FHA. I try not to do that because the terms of the loan are terrible. There are some institutions that will go down to 585. I can't imagine doing a loan with a credit score of 585 because the terms of that loan, oh my gosh, it would look horrible. But you can. So if you go below 640, we're definitely going to be in FHA. And again, we're going to do that because we're going to get number one, you can do it at FHA. You can't go below 640 on conventional. Any questions on that? Next becomes your debt to income rate. Let me just make sure I check these off so I don't miss them. I did this one. Oh, one other thing on credit score, on credit. FHA's rules for bankruptcy are much more lenient than that of conventional. Conventional is minimum 4 years. You got to be out of a bankruptcy for 4 years from the time of the discharge. FHA 2 years, maybe 3 years, depending on your situation, but a couple of years and you can get out. You can go ahead and get an FHA loan. Credit has to be perfect for 12 months and 1 or 2 late payments over 24 months after a bankruptcy, or you're not getting a loan. So bankruptcies are possible. And if you come out of a bankruptcy, you can still get a loan. You just got to wait. Go through what's called the waiting period. All right? And it's from the discharge date, not from the date that you made your application.
A question. So it's 4 years for both the Chapter 7 and 13?
Yes. Well, now, Chapter 13, there's a little bit of a difference. Chapter 13, you can actually apply for an exception. You got to go to the trustee to do it. So you might be able to do 3 years. Usually a Chapter 13 means there's what they call extenuating circumstances. If you can prove extenuating circumstances, you can shorten the waiting period. All right.
Some people are able to buy them in 13 still. You can purchase homes and whatnot.
Yes.
Which is crazy.
I know, but they can.
Yeah, that's great.
They can. Now, I will tell you, it's much more, I think it's more difficult if you're on a 13 versus a 7.
It is.
And the reason I say that is 13, everything has to go to the trustee, whereas 7, once it's wiped out, it's wiped out. Do your waiting period, make all your payments on time. After that, reestablish credit, get yourself a new loan. I'm not saying everybody should go to get Chapter 7 bankruptcy. I didn't mean that. All right, big difference. And that's, I'm going to talk about debt to income ratios. On conventional, the debt to income ratio, you have, as you've heard me talk about, there's 2 ratios. There's your housing debt to income, oftentimes referred to as the front end, and then there's total debt to income, often referred to as the back end. Front end ratios, as a generality, you want to be somewhere under 41%, as long as the back end is going to be below 50%. So if you're 49.9, you're going to be okay on a conventional loan, as long as your credit scores are high enough. If you have a 680 credit score and you come to me and say, hey Greg, I'm going to be trying to do a 95% loan to value, 5% down, and I've got 682 credit scores, and my ratios are going to be 44-49. That's probably not going to go. It's possible, probably not. So ratios are going to be driven on both conventional and FHA. Ratios are going to be driven by what your credit score is. The higher the credit score, the better you can go. We have a loan closing tomorrow for someone, a young lady buying her first home. She has She's got 800 credit scores. She had, I think that all three were over 800. But her ratios are 47-47. She's only putting 5% down and she got the loan. It went right through. But that's because she's got 800 credit scores. So they're looking at it, they're looking at the profile and saying, hey, 47 front end, 47 back end, you can have a loan. Whereas someone else that it might be at 38, 48 with credit scores at 660, conventional may not take that loan depending on the size of their down payment. So debt to income ratios play a big part. So what happens to someone who's got decent credit score, 690, but they found this house they just gotta have, and they don't have any more money to put down, so their debt to income ratio comes in at 54.5%. Total debt to income comes in at 54.5. Front end's right at about 40, but they've got some student loan debt in there, and you add it all in there, and it hurts them a little bit. When you go over 50% in your debt to income ratio, we're almost always going to have to look at FHA, regardless of how good or bad your credit scores are. If your credit scores are real bad, you probably aren't going to get up that high anyway. But if you got credit scores at 685, 690, certainly 700, 710, and you have to go to 55% on an FHA debt to income ratio, you're going to get a loan. Now the front end can't be at 50. The front end's going to have to be down in that 40, near that 40% category. But if that's the case, you can get an FHA loan. So debt to income ratios play a big part in what we're going to offer to somebody on FHA versus conventional. Make sense? That's why we always have to ask people, where are you at? What are your... And by the way, debt to income ratios can be hidden. And I say hidden because this is why when you go get a pre-approval or you get a pre-qualification from a lender, whatever it happens to be, make absolutely sure that they have looked at all of the documents. Why? Because on people's pay stubs, there are things called garnishments or deductions. Sometimes you see that on a pay stub. They may not tell me that they're making child support payments. But if they're making child support payments and it's being garnished, it'll show up on the pay stub. So it's very important the lender looks at all of that in order to be able to determine what these ratios are going to be. Questions on ratios? Perfect. Mortgage insurance. If you're putting down 3.5% on an FHA loan, anybody know what the monthly mortgage insurance factor is? Multiplier? You're not expected to know that. That's my job. But I just was curious. So the factor is, if it's 3.5% down payment, it's very simple. You take the loan amount, the base loan amount, multiply that times 0.0085. 0.0085. And then divide that by 12, and that's your monthly payment. That's for FHA, 3.5% down. If you're going to put down more than 3.5%, well then, instead of it being 0.0085, the factor is 0.008. So they don't give you much of a break if you're going to put 5 or 10 or 15% down. Somebody says, Greg, why would somebody put down 10 or 15% on an FHA loan? Well, what we just talked about, they got low credit scores or they've got high debt to income ratios. So we got to put them into that type of loan. So they got to put down 10 or 15%. But the MI factor doesn't change very much. It hardly moves at all. Now, are you aware that on every FHA loan, 100% makes no difference how much you're going to put down, whatever it is, every FHA loan has upfront mortgage insurance. Anybody know what the upfront mortgage insurance is? 1.75%. Thank you, Chris. 1.75%. I've been doing this almost 33 years. In 33 years, 100%, well, 99% of the people I did loans for on FHA financed the upfront MI. One person did not. I don't know why that was. That was weird, but one person didn't. But everybody else finances it. So 1.75%, So you're 3.5% down payment, 1.75% mortgage insurance added into the loan amount. So when somebody looks at their sales price, then they look at their total loan amount. If they're getting an FHA loan, they're saying, well, that's not 3.5% difference. And that's because 1.75% doesn't come to us, doesn't go to the mortgage company, goes to the Department of Housing and Urban Development for the privilege of getting an FHA loan. All right? Monthly mortgage insurance on conventional is driven heavily by credit score. You'll notice I didn't say that for FHA. FHA, 3.5%, 0.0085. More than 3.5%, 0.008. Makes no difference what your credit score is. So if you've got a low credit score, 662, and you want to get an FHA loan versus conventional, or you're going to look at the both of them, conventional, it's very probable that if you're putting down just 5%, you're going to get an FHA loan at 0.008, and it's very possible you could be at 0.01. You could be higher, maybe even above that, if you've got a low credit score on conventional. But if your credit scores go up on conventional, 680, 700, 750, 770, whatever it happens to be, if you start getting up in those high numbers, your mortgage insurance premiums, they come down to almost nothing. If you're putting 10% down or 15% down, oh my gosh, you can get a multiplier of your loan amount times 0.0011 divided by 12 for your monthly payment if you have high enough credit scores on a conventional loan. So conventional is driven by your down payment, by your debt to income ratio, and by your credit score. So a lender can, if you call a lender and say, Greg, what's my PMI going to be on this loan? Well, I got to know your credit scores, I got to know your debt to income ratio, and I have to know your what your final loan amount is going to be, so that I can do that calculation, because we don't know. Conventional drives by multiple factors, whereas FHA is just a down payment, that's it. And it's all flat the same, doesn't make any difference. And again, you're not going to remember all this. Just remember either my phone number or whatever lender that you like to use. If not me, I don't understand. No, I'm kidding. But whatever. That's what you've got to know. But it helps that you have some of this that you can advise the buyers, because what does it do? It makes you more credible. Okay, two more quick things. I've already mentioned about interest rates. Interest rates are going to be driven heavily by your credit score. Even FHA to a point, not as much as conventional. If you go up over 720 and you're getting an FHA loan, that's a little odd, but if you are, you will get a little bit better rate than somebody at 660. If you get to 680, it gets a little bit better. Go down below 640, it's not very good. Conventional can make a big difference. Anything over 660, 760 on conventional is pretty much going to get the best whatever the market has. As you start dropping 20 points, its rule of thumb is an eighth in the rate. Doesn't mean it's going to be, but if somebody's at 720 versus 780 or 775, you're probably going to be a quarter, maybe 3/8 higher. So every 20 points on conventional, it's going to move. The other thing that's going to cause that to move on conventional is your debt to income ratio. If I have somebody that's got low debt to income ratios and they're getting a conventional loan and they're putting 10% down or something of that nature, their factor is going to be lower than somebody who has a lower credit score. So a lot of factors go into play when you're dealing with a conventional loan. And interest rates, again, conventional is going to drive much more based on your credit score than will FHA, much more, especially if you go below 700. Last thing, FHA. Anybody tell me how much the seller contribution towards closing expenses can be on an FHA loan? Anybody know? How much?
2%.
How much?
2%.
No, 6%. 6%. I don't know that I've ever had an FHA loan that used all 6%. I mean, that's pretty obnoxious. You'd have to have some really high. I've got one right now that's just over 5. It's a manufactured home with somebody that has a 642 credit score. So manufactured home, interest rate goes up. Actually, interest rate stays the same. Discount points go up. And we're throwing the discount points into the closing expenses so that the seller can pay them. So, I mean, but 6% on FHA. Anybody know what the differences are on seller contribution on conventional? If you're doing 5% or less down, what can the seller contribution be? I'm going to give you two answers to that. First of all, you know that closing cost sheet that I have that I've passed out a couple different times? On the closing cost sheet in the bottom section, see, you don't have to remember any of this. You just got to look at that closing cost sheet. It tells you. If you're doing 5% or less down on a conventional loan, it's 3%. If you're doing 10 or 15 or 20%, it is 6%. Just like FHA. If you put 25% down or more, I've never had this happen. But believe it or not, you can actually do 12% seller contribution. I've never seen that happen, ever. But I don't even know why they have that in there. Some regulator must have thought they were doing somebody a favor. I don't get it. But anyway, so seller contributions vary considerably on conventional loans, but not so much on FHA. And you say, Greg, why are we talking about seller contributions? We haven't done seller contributions in almost 2 years. And the thing is, we're starting to again. And we did them a lot prior to COVID. And now we're starting to see them again. This one manufactured home I've got. I mean, this is the second contract. First contract didn't work out. Second contract for these people, and seller contribution is $12,000 toward closing expenses.
Can I ask a dumb question about closing costs?
No dumb ones. It's
So
fine.
if you've got somebody that's pre-approved, let's say at 300, that's the pre-approval amount, could they offer 305 as long as there's 5K in closing costs as a part of it, or can they only offer 300?
It depends on their debt to income ratios, because the qualification was probably based on a down payment off of 300,000. So if you raise the sales price to 305 or to 310, now the down payment is going to be based off of that. As long as they still qualify, they can do it. But now you've got to get with the lender to find out, will they qualify for that amount? That's really what it comes down to. Does that answer the question, Lanier?
Yeah.
Anybody else? Well, guys, thank you. You've been very patient. We've used up all 30 minutes. I appreciate it. Thank you.